So let's look at a very simple example, obviously much easier than you might have to do in your exam, in terms of calculating a company's tax liability. Now, it's for the year ended March 20. I know we've really said we're not bothered about financial years, but just to point out, that would be financial year 19 because it runs from April 19 to March 20. We've got the tax adjusted profit, so that's a profit after capital allowances. We've got some profits and gains, we've got some non-trading interest, we've got some dividends and a charitable donation. So the first thing I'm going to do is I'm going to cross out the dividends because they're UK dividends, and that means that they are exempt, and therefore all we need to do is add all of that together to get our total taxable profit. All right, so we're going to add together all of the income, take off the charitable donation because that's what we class as a QCD. Remember, charitable qualifying charitable donation, like a gift aid. So we get relief for it here because we would have disallowed it when we did the adjusted profit. So if you add all of that together, you get 1,160,000, and that would simply be taxed at 19%, which give you a tax bill of 220,400. So that's the basic idea of what we're trying to do. Obviously, in your exam, it's not going to be quite so straightforward because you will have to work out some of these. You're not going to be given everything and just have to add it up. But that's the idea of what we're trying to do. So we're going to build on that as we go through these examples and do slightly trickier situations. Now, underneath, there's a little section on short accounting periods. And basically, we don't need to worry about anything when it's a short accounting period, apart from prorating your capital allowances. So when you work out your capital allowances, whether it be your 18 or your 6%, you've just got to say, well, that's for a year. So if I've got a short period of accounts, like this one here is for 10 months, I would do 10/12 of that. So you'd work out 18 or 6%, depending on what pool you're looking at, and work out 10/12. And then you've got that annual investment allowance of £1 million, which you also need to prorata. Apart from that, it's exactly the same. So with this example here, we cross out the UK dividends because they're exempt. So they are not going to get taxed. So our total taxable profit would be 240,000, and we just simply multiply that by 19%. What we're not going to do is we're not going to prorata the 19. The profit is already for 9 months, and therefore we're just going to take the tax on that 9-month profit, and that will give me a bill of 45,600. So the message here is, do not prorata anything for a short period unless you're dealing with the calculations of your capital allowances.